Lots of student loan stuff cooking. So I wanted to bring you in. It's been a little bit since you've come on, but I know Jeff is my guy with student loans. He kind of like enjoys this stuff, looks at it on the weekend level of knowledge with student loans. So he's definitely in the know with student loans, and they have been changing like crazy. And there's some new stuff cooking and also some of the big things ending that I wanted to talk through with Jeff today and make sure you guys were in the loop on some of these big changes coming down the pipe.
Yeah, you sure make me sound like a real pleasure to have at a party. The guy that reads student loans on the weekends, huh?
Yeah. I mean, it's good to have, but
Scary that it's probably a little bit true. So, yeah, you're right, though. There have been a lot of changes. I mean, in the last 5 years, but in the last year, just on its own, we've had a lot of changes, mostly in the good direction as far as
mhm,
student loans go. A lot
yep.
of the headlines tend to be negative ones, right? Like student loan cancellation blocked. I guess that depends on who you're cheering for there. But those are the ones we hear about. But there's bigger news, bigger changes really than any of the things that get headlines, especially as it applies to our physician families and those that are looking at, paying on large amounts of debt and maybe even looking at some of the loan forgiveness options that are not as headline driven.
Yeah. And I think, like you were saying, these are much bigger changes. And I think I'm still hesitant to say this, but I think that there's going to be a little more certainty going forward because there's been a ton of things changing, but it's been like everything's on hold kind of. So it almost feels like they've taken away all the urgency to do anything about anything related to student loans. It's just kind of like, well, I'm not paying any interest and I'm not making any payments. Like things are kind of on hold. And it's been like that forever, it feels like. And so I think that's a little bit of a positive too, is that it's hopefully going to create some certainty or clarification and allow us, we're planners, of course, so we always want to have a plan and allow us to be able to start making some plans again around our student loans, which will, I think, help you guys as well, just to start to have a little bit more certainty around like what things are going to shake out. And the real benefit is for a lot of you listening is the PSLF stuff, like Jeff was saying too, like these one-time forgiveness things, they're, okay, but like PSLF is huge and that adds up to a lot. And, more of you are able to qualify for that. That's a huge potential win. So there's a couple of those provisions too that might impact a lot of you guys. So maybe, Jeff, we could start with, I think the one most people have heard about, the payments, of course, are going to resume, right? Like when's that happening? What's the details with that?
Well, yeah, you just mentioned that there hasn't been an urgency to some of this for a while because there are these deadlines of when payments would kick back in and they just kept getting pushed back.
hmm
But at this point, I'm going to give it a 99% certainty, but that payments are resuming here and they will be resuming as of October. So the pause officially ends here at the end of August, which at the time of recording here is less than a month away. And then interest will start accruing again in September, with payments actually getting due dates and resuming in October. And so
hmm
it is coming. Payments will resume and they should be kicking back in at whatever your previous payment level was if you were on an income driven plan, or I guess any plan that you were on before the loan pause started. So, and then maybe you weren't even on a plan or had loans when the payment pause started. So,
Yeah.
uh, that'll be something to keep an eye on as well. But they should resume right where they left off.
Yeah, so there's a lot of considerations there just with that one change, I guess, or program ending. And so, for example, if you're one of those in the situation where you've been kind of like holding out on refinancing to a private loan, because why would you refinance something that has a 0% interest rate? I know a lot of people are in that camp. And so if you're in that situation, it seems like now's the time to start looking at seriously like pulling the trigger on refinance or at least comparing those interest rates again, because September, you're back interest paying world. And then with income recertification and payments coming due again, everybody's situation is going to be different. So that's how it always is with these things. But like, I think for a whole lot of people, like a big slice of the student loan borrowers are going to be like better off like sticking with their old default payment, which will kick back in. So your most recent payment that they have on record or your most recent income verification, that'll be what will kick back in, like Jeff said, once those October payments start. And for probably a large chunk of you guys, that's going to be great. And you kind of want to let those roll as long as you can, and the longer the better. But then you got to think about, I guess there could be exceptions to that. So that's why I say, like, it depends on the circumstances. Like, some people might still want to recertify, especially if circumstances have changed to where the payment could be lower. So that's like an exception to that situation where you got to really look at your situation. But generally speaking, a lot of you guys are going to want to, like, go ahead and, take that as long as you can. But still, you got to start to think about, like, when is that next recertification as well. And we should know that information already as well, right, Jeff? Like, when your next recertification should be.
Yes. So you can certainly find that. And it sometimes it's hard to dig in and find, but you can find it on studentaid.gov. You can get a file there and look for an IDR anniversary, or your student loan servicer may also have this, but that's been a little more hit or miss. But the big picture is that right now, it is very likely that no one that we're talking to has to recertify income prior to the end of the year, and likely sometime well into 2024 at this point.
Mhm.
If you had a payment date or a recertification date that was happening throughout the year, anytime beyond 6 months past the payment pause, it gets pushed out another year. So basically, if Daniel, if you had a July certification date and it said it was July of 2023, that's now July of 2024.
Mhm.
If you have a December certification date, December of 2023, that is also within 6 months after this pause ends. And so that would also then get pushed back a whole nother year. So
So let me make sure I understand. So if your current date is within 6 months of the pause or
right.
ending date of the pause, then it goes another year.
Right. So the effect of that is basically no one should have to recertify their payments again until 2024 at some point, possibly even a little bit later, but vast majority 2024.
So if my repayment date was June of 2023, it's going to be June of 2024, right?
Exactly.
And if it was like November 2023, it'll be November 2024. But if it was like, let's see, March of 2023,
That could be in that borderline area where you're going to need to examine this a little bit more
yeah.
based on
So
final guidelines on this. But
yeah, so repayment plans, I think the takeaway for you guys listening is keep an eye on your repayment plan recertification date. That's going to be important to understand when your next income recertification date is, because that's when they're going to require you to recertify. There, like I said, there could be cases where you want to do it earlier than that, but you want to know when that date is so that you can ideally you think about possible strategies, because there's typically, like, been a while since we've had to do this because nothing's been happening with student loans. But once we go back to the rules, it's going to be like, okay, well, let's think about how we want to file our taxes, or do we want to try to do it as early as possible or wait to the last minute, or do we want to do pre-tax retirement plans, or like there's all kinds of strategy around maximizing PSLF or even long-term forgiveness to think about. So that's an important takeaway. So payments resume, and clarify what your income repayment certification date is. That's an important takeaway. It's been so long you don't even remember what your payment was. It would probably be good to look at that for budgeting purposes, because you want to kind of plan for that. I think a lot of people, I think we did a show on this of COVID forbearance lifestyle creep. But a lot of the families we worked with, and natural human nature would be that you'd get used to spending those payments. So you got to think about how are you going to start making them again too, right?
right. I actually remember you doing that show, Daniel, and I remember the advice was to go ahead and save those payments along the way so that you're used to making that payment. And just in case anyone out there did not do that, or maybe you didn't listen to that episode, uh,
Yeah.
it's a good time to go ahead and start to build that into your budget now.
Yep. Now, if you're working with us, we can help you with it. We're keeping an eye on it already. So, all right. So, some of the big new developments. So, maybe we can start with the new repayment plan that is out there.
Yeah, so that's probably the biggest change to look at because it's going to have some trickle down effects into other ideas here too. But yeah, there is a brand new repayment plan that's been announced called the SAVE plan, or the Saving on a Valuable Education plan. I like how the acronyms work there. We got SAVE.
That's what it stands for.
Yeah, so if you had a valuable education, you can now save on it. I don't know what they do for non-valuable educations, but just kidding.
We got to use a different acronym.
Right. Good. I guess good news. The save plan is an option that is available for all of our student loans. So the federal student loans, anyway. And so no matter what your education experience was, it's going to be available for
On
the
any loan.
loans. Yes. And it's actually a replacement, or you might even call it an improvement on the old revised pay as you earn plan, or repay or repayee, depending on how you like to say that. But yeah, in effect, it's taking what revised pay as you earn had in place and changing some of the numbers that are in there to calculate payments in a way that really is beneficial in most cases, and also allows for a little bit of strategy within the plan that wasn't there before. So I guess the key components there are that when we're talking about how the payment's calculated, the poverty level that's factored into it has been increased from 150 to 225%. If you didn't care about that part, what it effectively means is that payments are going to be lower on the save plan than they would have been on the equivalent revised pay as you earn or repay plan. So overall, that's generally a good move or good direction there for the save plan.
Is there a case where I want to keep, maybe to clarify, repayee is not going away technically for existing borrowers.
Repayee is morphing into the save plan. So if
Can I stay in repayee if I want to stay in repayee?
No. So repayee is just changing. And so ultimately, if you're on repayee, that's okay, because this is
better,
only improvement on.
There's no downside to this versus repayee.
Right. So the poverty level they take into effect is higher, which means
payments are always lower.
So payments are lower. The borrowers, so this doesn't apply as much to the med school debt, but undergraduate debt, you'd pay 5% of income on, and graduate debt is 10%. So if you were doing mostly undergraduate, then the payment's lower as well. It is just 10% of your income for current repay plans. And the downside there, though, is just like the current revised pay as you earn plan, there's no limit to that income driven plan. So that 10% of income is 10%, whether you earn 50,000, 500,000, or $5 million a year. So those payments never hit a limit, which is also true on revised pay as you earn. So it's still not a detriment to that plan, but something we'll want to keep in mind in just a minute as we talk about the negatives here.
Yeah. So repay is gone, will be gone, and be turned into save. And there's only perks or only benefits relative to repayee. Now, when we start to compare to like payee, there's some downsides that could be substantial because there's a cap on payee. Like that cap for physicians, if you are on PSLF or even long-term forgiveness, payee has that cap based on your income. You can't go above a certain threshold, which if you have a really high income, that's huge potentially. How does that work for someone on payee?
Yeah, that's a great question. So on payee, it would be that you would never have to pay more than what you would normally have to pay that loan off in 10 years. So that's the upper limit of your payment on some of the other plans that are out there. But revised pay as you earn in this new save plan doesn't have that limit. So if you could pay off your loans for $5,000 a month in 10 years, Daniel, that would be the upper limit on pay as you earn, on income-based repayment, right? But on the save plan or revised pay as you earn, that could go up to, there's no limit. So you could end up paying 10% on your income of $1 million a year. And now that payment is significantly higher than $5,000 a month.
But can I stay in payee if I want to maintain that?
Yeah. So for now, you can. And if you are on pay as you earn right now, which is the plan that allows you to cap that, you can stay on that plan. However, new enrollment in that plan is going to go away less than a year from now. So in July of next year, there's no more new borrowers, no more switching into pay as you earn. So that gives us a little bit of time-oriented action.
If I'm like a super high income specialty and I'm early in training, and I don't know if I'm going to be PSLF or not, I would really be thinking about maybe I should try to get into this payee deal before that window closes, because it used to be that you always had that option, but you're going to lose that forever. Because if you did end up in a PSLF type job in a high paying specialty, that pay becomes super valuable. So that's an important kind of takeaway there. How does it work with all this interest that's built up in all these student loan accounts that's not yet accrued for all these changes? Is there like a big, I mean, normally when you change repayment plans, there's a capitalization event where all the interest gets added back to the principal and they start charging on that. But do you know how they're going to handle that with all these changes?
Yeah. So in general, right now, what they're looking at is a change in payment plans, or like an administrative forbearance is not going to capitalize interest. It may
Okay.
not go away, but that is a small step in the right direction on those loans not ballooning to be gigantic as you make changes all the time.
Yep. Okay. Are there other big provisions or considerations with save?
So I guess a couple of other kind of interesting ones are that the old repay plan that it's built on did not allow you to split your income. So let's
Mhm.
say, you couldn't file taxes separately. It always took everybody's income into account. And so that does present an opportunity now to file taxes separately and change how much income
So now
you use.
everybody going for PSLF is super complicated.
So everyone going for PSLF is,
Everyone going for PSLF that's married to a spouse that earns income is super complicated.
yeah, it throws another decision point into there, right? Of
Funny how anytime these changes come about, they're like sold as simplification, but they seem to complicate things for a lot of people. That's just the nature. I mean, I consider that opportunity because we can be strategic and help you kind of like work around things. But it is much more complicated when you have that added consideration of filing separately versus not.
Absolutely. Absolutely. Because then you got to go with the filing cost. It usually
Mhm.
costs more to file separate versus the savings potential, and
Yep.
gets really fun. That's
And
why it's
then
a
what if you're
beautiful
in a
puzzle.
community property states and, because its taxes
Yeah,
work differently if you file separately and
if you're in a
it,
community property state, either get deep into the blogs on student loan planning out there, or
or
get
pay someone.
or talk to a consultant, because there are so many opportunities there,
Yes.
yeah, to save money if you're going for
You
PSLF.
can hire Jeff and pay him. He will work you around all these
Yeah.
rules and whatnot. And I mean, especially in that case, like you said, it's worthwhile to, I think, pay for advice. Okay, so that's the new save plan.
Yeah. One other big benefit there is it eliminates 100% of any remaining interest. So if your payment's not covering the interest, it used to eliminate 50% of what you weren't paying on the
Mm.
repay plan. Now it's 100%. So if you're not covering the interest,
Used to do that on subsidized loans for repay.
yeah, there was some nuance there, right? Where it was for several years on a certain
Yeah, it was.
portion, it would
Now it's
cover it.
100% on all the loans for indefinite.
Yeah, both subsidized and unsubsidized, it covers 100% of any remaining interest. So for those that we have here that maybe are going into this payment resumption with a $0 payment, or coming out of school, or don't have your plan settled quite yet, finishing residency and maybe not quite sure what that first job looks like, or you're ready to get into that first job, this save plan is
Pretty appealing.
likely a good option,
Yep.
unless you're expecting a huge jump in income when you want to go to that pay plan, because you're
Right.
basically getting an interest-free loan for another year.
Yeah. Yeah. It used to be, I mean, we did this back in the day. I guess it's been 10 years almost since or even more than that, since we were talking PSLF with people. But early on that, like the difference between repayee and payee, it was all about this payment cap and the interest subsidy part of the repay equation. Basically, and it was probably skewed towards repayee. Like the majority of people probably should get with repayee in training, but like maybe 25% would go with payee in training. But now that's just swinging the pendulum further towards this repayee slash save sort of route where I don't know, the majority, probably 80% or more, 90% maybe of people in training should go with this plan over payee. And I guess payee is going to go away anyway. And this is going to be the only option.
This will basically be the only option. There'll be yeah.
Are the old options going to still there?
So they're
They need
all the
goodness.
synonym sounding things, like the overall thing we have to have here is an income driven plan, IDR, but that's
Yeah.
not a plan itself, right? So you've got income contingent repayment. That's going
Yeah.
away. Sounded a lot like an income driven, but it was income contingent, right? Income based repayment, the old version is gone, but the new version still remains. So that may still be an option to look at coming out of school or out of residency in the
New
future.
IBR is staying put.
New income based repayment. That's what, and if you don't know what new is, it's just,
Yeah,
it's still available. We'll put it that way. It's a lot like pay as you earn for
yep.
brand new borrowers. So that has a limit of if you've made more than 60 payments on this new plan, you can't go back to it, but it'll still be available. So,
Yep.
but then for the vast majority, and this is what we're seeing as we look at the loan balances, the payment options, the save plan is going to be the best option for, I would say, 80 to 85% of the individuals we've looked at so far,
Yep.
because it is generous and the payments are lower until you hit that cap. So
Okay. So
hopefully
generally
that,
speaking, this is a win.
generally speaking, a win, unless you got a
I mean, you
low,
do have to make payments,
yes,
but
unless you have a low balance for the loan or high income, very high income to that loan balance would be the two things to keep an eye on.
I guess it'll be easier to have $0 payments in training, though. I bet that'll be more common. Is your payment in air quotes will be zero or low in training because your income is low because they're using a higher poverty threshold. We'll have to see. Okay, so that's a big change, generally for the better.
That's a big change. That's a technical change too. I think a
That's very
lot of the
technical.
other ones are a little bit easier to say, yeah, that matters to me.
Hmm.
But there are a few other ones out there, right?
Yeah. Okay, cool. So PSLF is also having some changes, like the way that you qualify. So full-time employment, I know there's some changes. Well, there's changes around how they define your employer and then also what they consider full-time because you always have had to been full-time employed in order to qualify. So let's talk about those big changes. These can be massive for some people.
Oh yeah, if it applies to the individual, like these are game changers to some employment decisions that we see and some plans overall. Probably the easiest one is that the definition of full time has been simplified. And so now it is a straight number that says if you are working 30 hours or more per week at a nonprofit or a combination of nonprofits that add up to 30 hours a week, you are full time in the eyes of PSLF.
And that is independent of, like, say your employer says you're part-time or maybe you don't even get benefits. Like,
Right.
let's say you're a physician that's point 0.6 and a full-time physician, one full-time equivalent is like 80 hours a week. So point 0.6 is whatever that is, 60% of 80 hours, greater than 30, right? So,
Right. Yeah. So it
and
was, yeah, previously it was like an hourly requirement if there was an absence of a clear definition from the employer. So, some places would call 32 hours full time, others were 36 or 40, or, you're going on the FTE scale, right? It could be just zero point 0.6 doesn't count, but 0.7 did. And so
mhm.
now this gives a definite definition of if my employer, if and I send them a certification form and it says 30 hours a week and they sign off on that, that's going to count no matter what they call full time
Hmm.
or not.
Yeah, that's a win as well. That's making it more generous. I know there's a lot of physicians that are part-time in air quotes, but really they're full-time. And then there's also a lot of you guys that are like on the window
Mhm.
of full-time, part-time, and your employer maybe calls you part-time, and that's been killing you for PSLF. So 30 hours is the line. That is much more straightforward.
Much more straightforward. And yeah, it certainly helps out for anyone that's just looking to scale back or a spouse
Mm.
that's looking to scale back and still not take PSLF off the table completely.
Yep. Okay. So that's more straightforward. What about the other changes related to your employer? This is definitely a little bit more complicated, but it's a big win too.
This one is less straightforward, but still certainly a help here. And that's that the definition of a PSLF qualifying employer has now been expanded, where particularly in states like California or Texas, if you are employed by, so if there's a state statute that says that you cannot be directly employed by the nonprofit, and that's very common with, for example, Kaiser Permanente docs over in California would be a very common example. You can now go to the nonprofit level and get their contact and their employer identification number to put in as your employer
Hmm.
and get credit, where you used to have to go to, if you went to Kaiser Permanente, for example, not a nonprofit, so it just wouldn't count. That's your employer. But if you're a Kaiser Permanente doc that works at nonprofit hospital A, if you go to nonprofit hospital A that wasn't allowed to employ you directly, they can sign off on that employment. So it expands that for certain individuals. So
Yeah. And it has to be that your location, wherever you're at, has to have, it's designed for the setup where the law says you cannot be directly employed by a nonprofit hospital. And so they've created these like employer organization workarounds that are typically for profit. In that sort of circumstance, you can go straight to the nonprofit and get them to sign off on your employer certification and therefore begin to qualify for PSLF.
Exactly.
I imagine there's going to be some confused employers
You think so?
because they're going to be like, what are you sending me? I
Yes.
mean, I don't know. I just imagine that.
Yeah, this is a brand new change effective as of July. And so there's not a whole lot of history here to draw on.
Mhm.
But if you think that this applies to you, I'd be, communicating very proactively with the hospital or the nonprofit that basically your provider, your employer is a contractor of. Find out who you should go to certify that, and then you can get that employment certified at the hospital level instead of your direct level, like where who
Mhm.
signs your paychecks, right?
Yeah. So first thing is you got to figure out if you're in an area where laws require you to be not employed by nonprofits. Second of all, if you're in one of those areas, go to the directly to the nonprofit, not to this organization you're working for, like Kaiser Permanente. You're going to the main Kaiser, like the nonprofit hospital division of Kaiser, and not your physician employer for profit group. And you're talking to them about like, who do I talk to get signed off on this? And I
Yes.
imagine they'll be like, "Oh, what are you talking about?" I mean, in some cases, I imagine they'll be like, what are you talking about? So it'll probably, if you're like the trailblazer that's like doing this first, you'll probably have to be like educating them. I
Mhm.
just can see that happening. So I wouldn't be surprised of that response. And then if I hear that response, I'm going to start sending them all these laws and provisions and student loan stuff. Be like, here's the stuff. It's right here. And then you'll have, probably have to get them caught up to speed. But that's a good thing.
Yeah. Probably the easiest thing to reference is on studentaid.gov. They have a what is a qualifying employer FAQ. And in there's a drop down that kind of explains in a couple of paragraphs to at least get the conversation started. What's the worst case scenario? You could ask and go down this road and hear no, right? But for somebody that it might apply to, I mean, this could be a game changer if you've been working for 5 years and now you're all of a sudden eligible for PSLF where you weren't before.
Yeah, that's big time. I mean, it's straightforward, but I imagine it'll take a little while to get this all sorted out. Is it just that situation, nonprofit, like where you're not allowed to be employed by the nonprofit setup? Or are there other people that would potentially, wasn't there some changes around independent contractors?
Yeah, and it's basically the same issue at play, but
Okay.
you may be structured in a way that you're employed by a what they call a contractor organization.
Like a team health?
Potentially, especially if you were in, again, I'd say Texas or California, put yourself on red alert that this could apply to you. Other states, not nearly, almost no chance in most other states. But then it would also apply to if you're in the same situation where by state statute you can't be employed by the nonprofit, but you're directly contracting with them and being paid 1099, or you have your own S corp or something like that. That still could work out as long as you're being prohibited from that direct relationship by state statute.
So like a team health physician working for team health, or they're not working for team health, they're independent contractor at team health, but say they're working in a nonprofit hospital. Is that kind of in the gray, or is that
Yeah, that would come down to the state, whether if it's set
if
up
I'm
that
in
way,
California and it's
if it's set up that way because you are not allowed to be directly employed, then that
mhm.
counts. If it's
Part I
just
am curious about in that scenario is like, I know team health typically is not in existence to work around that rule. Like team health is designed to work nationally and independent and allow for physicians to be independent contractors. Whereas these physician Kaiser example employment groups are designed to employ physicians because they can't work directly for the nonprofit. So I wonder how that works. We might be getting into the weeds. It needs to get shaken out still, but
I'd say the worst case scenario is you go down this road and you ask the hospital and say, "Hey, is there somebody that can sign off on this?" And they say, "No, you dummy. That's not how
hmm,
the state works," right? Like, "Oh, okay, sorry, I'm not a student loan expert." Okay. But yeah, I think there's certainly gray areas that are going to be sorted out over time as well, which
yeah,
seems to be the case with any of these student loan changes that happen too.
right. Okay, so California, Texas for sure. If you're actually like physically working in a nonprofit hospital, but like you're not employed directly by a nonprofit, this is
You're a
something you
likely
for sure
candidate.
at least should be looking into and kind of starting to do a little homework on this, and it could be a big potential benefit. All right. Cool. Well, consolidation, there's a small change here on consolidation. This change should have happened a long time ago, I think.
Oh yeah, but it has messed up a ton of people in the past, and that is consolidating loans now is not going to reset your clock at zero payments. So it used
For
to be
PSLF
right, or even
or
the long
IDR.
term amount. So it used to be consolidating out of your old direct loans, or out of your old direct loans would say you had 50 payments, 5 year, 4 years in the books, and you're like, I'll do a consolidation and get loan number 6 out of 5, put on there too, and then your 50 payments went to zero, no more payment progress, and it was devastating to
Yeah.
those that's happened to.
Yeah, but then they decided to give it back to them over COVID, and but then a lot of people, a lot of people, the worst situations was when that caused you to not get any PSLF benefit anymore, and you
Refinance.
refinanced out, and then that's a sad, unfair situation. But that's how these go sometimes. But at least they're fixing that going forward, which is good news.
Yeah. So
And
going forward, it'll be the weighted average of the payment history. So, if you had 3 loans that had five
oh, okay,
payments and 10 loans with it depends on the balance in the loans, and they throw it
that's
all.
just like they do with the interest rate.
It's just like the interest rate where it gets averaged out with a weighted average. And
Mm.
so you'd have a weighted average of that. So you wouldn't have the longest payment history, but it wouldn't be reset at zero either. Now,
I could see that becoming a problem.
that's still worth analyzing if you're in that
Because if you have a
situation.
big loan with a really long or a large amount of qualifying payments, and then a really tiny loan with like one, and you consolidate, I don't know how they do the weighted. I guess it depends on how they do the weighted
It is weighted
calculation.
based on the balance. So it
Okay.
it would
It's
pull
not.
that small loan significantly further ahead than it would pull the big loans back. But if you don't want that to be you, if you don't even want to have to worry about that calculation, we still have this year an IDR account adjustment, so that if you have these consolidated loans or anything before the end of the year, the longest payment history counts. So it kind of takes the combination of the two and throws it together. But that's a very time limited
You
change.
just need to do that before the end of the year.
The end of the year.
Okay. And that's important for if you're going for 20 or 25-year forgiveness, right?
It's important for 20 or 25. It also applies to PSLF.
Or PSLF. If you haven't, hopefully you've already done that if you're going, well, either one. Hopefully you've already done that where you've consolidated to get the longer of the repayment histories, qualifying payments. But yeah, you have until the end of the year to do that. That got extended, right? A couple times.
So yes, that did get extended. It was originally set to be done here early this it was in this spring, and it got
Mhm.
pushed back to summer and then finally to the end of the year.
So who is that important for? If I'm listening to this and I mean, I know if you haven't consolidated, maybe something to think about. Well, who is it? Who are some of the people that we should, I know FFEL loans is one.
So yes, there are really kind of two major cases I can think of right now that you may want to get on that consolidation before the end of the year. And that would be one, if you have the old FFEL loans, the ones that were before the direct loan program was really in full swing, or Perkins loans, and you want to get credit towards PSLF or long-term forgiveness, those need to have a consolidation
Mhm.
application anyway in place by the end of the year. And so that would get all of those loans eligible for PSLF versus, direct loans being eligible, FFEL loans not. So that's one reason you might consolidate here by the end of the year. Another case, and this has been an interesting one, is with all the adjustments. And so I guess real quick, those adjustments were that basically any payment and under any plan, and even some forbearance and deferment periods, are counting towards PSLF and long-term forgiveness. And so that's really added to the count that a lot of individuals have towards forgiveness. But if you have a loan that has a really long payment history, case study example would be a couple I can think of right now that have been paying on their student loans since 1999, on old income driven plans. And so they've got a lot of payment history there. They are now eligible for those loans to be forgiven under the 25-year payment
Hmm.
program. But they also are now at the point. So if you had loans that long, they're as old as your kids, right? Maybe older. You might also have kids. So in this case, maybe you have kids and you've taken out plus loans for the kids. You could consolidate those loans by the end of the year. And the loans that had the 20 or 23 years of history about ready to be forgiven get applied to the history of those brand new loans.
That's ridiculous. That's
And
crazy.
yeah, certainly an unintended effect here, but a use case where you want to get that history applied
Mm,
to other loans. And so that would be a case for consolidating.
yeah.
One reason, real quick, you might not want to consolidate, though, would be you mentioned this right at the beginning, Daniel, is for a lot of the individuals we're talking to, you don't want your payment to change in the next year. You want to drag that out as long as possible. And consolidating is going to force you to certify your income. So you're going to get a higher payment likely than you would have back in March of 2020.
Hmm.
So
Yeah.
if it's only one payment difference, may or may not be worthwhile.
That can be a big downside, especially if you went into practice while COVID forbearance was happening and your most recent income certification was in training and your payments were low. And then you want that thing to keep going as long as possible. And then if you do this whole consolidation, that's where we're getting into the complicated stuff. It really gets complicated, but you have to weigh the advantages of this potential consolidation and using this oldest payment versus the costs of having a higher payment.
But yeah, those are the two cases. If you've got old loans that wouldn't qualify for PSLF or any other type of forgiveness, it may be worthwhile to look into it. And if you have really old and really new loans, also a good opportunity to look at it at least. So
Yep. Okay. Cool. That's a lot of change. There's other stuff still though, right? Did we missed a couple?
yeah, there are a few. I think probably the most celebrated just quality of life change is that you can do your employer certification with DocuSign now. So if you go to studentaid.gov and put in your employer, as long as you have a contact to send it to, you can send it from DocuSign through studentaid.gov. And you don't have to get the wet ink
Does it?
signature. You don't have to take the picture of it. You don't have to go back and forth. It's completed and sent directly to the Department of Education then too. So
Doesn't it just require an email?
yeah, you just need the email of whoever the contact is. I'd suggest letting that contact know you're sending the certification to.
Or you could just give it a try and see what
I
happens.
mean, I don't know about you. If I get a random DocuSign, I'm probably not just
No.
open it and
Yeah,
sign
definitely
it.
let them know.
But it's definitely cutting down on a lot of the rejections that we've had based on signatures
Hmm.
or employment certification.
Yeah. Well, that's good. That's about time they updated we're in 2023 after all. DocuSign's been around for what? 10 years plus.
Yeah, so we've made it to about 2013 in student loan land.
Yeah. Nice. Cool. Well, that's a bunch of stuff. Anything else we didn't hit on change wise that's important or considerations?
I think those are the big changes to be
Mhm.
aware of. There's always going to be more, and we'll be talking about them, I'm sure, as time goes on. I think
Yep.
action items, though, what would you take away from this, Daniel?
I think knowing what your payment's going to be, dollar amount wise, budgeting for that, knowing when your next income recertification is going to be, trying to get a handle on when that's going to happen, and then planning for that. Those are important for everyone, right? Like,
Yeah, so knowing what you're going to pay and how long you have to pay it are probably the two things that you can just
mhm.
get a handle on right now and be planning around.
Yep.
And then just those time limited items of consolidating if it makes sense. So if you've got those old loans or they're mismatched by years and you need that payment history or just to make them eligible, take a deeper look at that and consolidate those by the end of the year if it makes sense for you. So,
Yep. And then for everybody, maybe you're in one of those exception categories, you got to look more at your circumstances, but like maybe some of these other things we've mentioned might make sense. And that's when you got to like dig into your circumstances. And I mean, like if you're in California or Texas working for a staffing contracted company for the nonprofit, or if you're in the window of part-time versus full-time, or if you're on repayee or payee and, looking at this save plan, those are, very much situational. Tax filing jointly versus separately, very much situational. And it's worth, if you work with us, definitely we're looking at it for you already, but keep us in the loop as you hear more information. And we'll be covering stuff as it comes out. Jeff will be sending me text messages over the weekend about what he read in the latest student loan developments. But hopefully the change, there's been a lot of changes, but hopefully this is kind of the end of the big wave of changes.
I would imagine this is the end of a big wave of changes.
As long as I've been working in student loans, there has been consistent changes. That's been the only consistency.
Well, yeah, I don't want to open up any can of worms, but I do think that the way that this most recent change has come about could then open the door for more changes to be done in the future. So we'll find out more.
Jeff's thrown out a little prediction, more changes to come. We'll see how that shakes out.
And it could be changing with every election and administration going forward.
Yes.
But as of now, all changes that we've had are generally positive, and so that's been a great thing in the last couple of years.
Yep. All right. Well, it's been fun talking student loans with you, and appreciate you coming on.
Well, it's been my pleasure. Thanks for getting into my guilty pleasure of a student loan informational niche here.